All right, the S&P 500 fell 21 points today as we head up towards and butt our heads up against some technical resistance. So we're going to take a look at that pattern to see whether or not we should expect more of this, and for how long. We continue to talk about that and what our expectations are. Are we caught up in a fake out right now? So we're going to look at that. Also talk about what's driving this price action, what we have ahead of us the rest of this week, and a stock that kind of made its own little breakout that's giving us multiple signals that suggest there could be a new trend underway for a new trend trade. So let's go ahead and get started. Today is Monday, January the 28th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator, as we always do. The intermediate line now up above 80, still above 80. We got up there last time, but you notice how we're still kind of hanging around this Fibonacci resistance area. You got the 50% retracement, the midpoint of the retracement zone, Fibonacci retracement zone. You also have this Fibonacci fan, the 62% Fibonacci fan that's holding us up on the other end. That's about the area where it crosses the 50% retracement line. So you've got some resistance in here. You are above the rising moving average, so it's green. It didn't turn green when you crossed. We were yellow for about 3 or 4 trading sessions. So keep that in mind. You also see too that the near-term line turned down without getting up above 80. So after coming up above 50, we're now at 3 days up above 50. The blue line being up above 50. That without getting above 80. So that would be potentially a bearish near-term high point, because it would be a high point that's slightly lower, right, from here to here. You can see the candle that gets highlighted when my cursor gets on it. From this candle to this candle, it's a slightly lower close. Obviously lower near-term peaks there. So it would be a bearish near-term high. And again, it's not like weakness would be a problem here. It's actually relatively widely expected that we'll get some kind of weakness because we've had this big run up after off that December 24th low point. And you can see the red lines being the Fibonacci retracements of that rally. So if we do get some near-term weakness, where can we pull back down to? And you see we can pull back down towards the 38% Fibonacci retracement, kind of hit this trend line that we had drawn in blue. You also see that's about where the 38% retracement is. Probably by then, you might hit down below this, or hit this Fibonacci, this fan, the 50% fan, for a support on the way back down. You see how it's continuing to move lower, and by then maybe hitting the 50%, if not this, this 2,500 area for a support on the way down. So would not be a problem if we went down that far, because remember how big we rallied. This means the pullbacks might be relatively bigger too. Will not mean that we're in a bear market. Won't mean that any kind of bullish bounce. It won't be necessarily a bull trap or bear trap. It will just mean that when we get these rallies off these sharp, significant low points, when we touch the 50-day moving average, typically we retest off of it and bounce off of it. And we went a little bit through it with that last little, kind of push, because everybody was expecting resistance at 2,600. So when everybody's expecting something, you tend to get a fake out move, and that's kind of what we got heading into expiration. And now we're coming out of expiration, especially with such a busy week ahead this week. We might finally get the correction of that fake out move and make our way back down and get that pullback that we probably should have gotten back here, which would have been a lot more healthy. We'll probably end up getting at now, which will give us a nice, much more solid base that we can bounce off of and then start a new trend that we're just not getting yet. If we take a look at the Dow Jones Industrial Average, see the same pattern developing here. Again, strong bullish posture, but near-term line falling. See, the near-term line didn't get below 50 in the Dow, so we've been up. This has been one big, long near-term run. Very, very long, mature near-term run. Same, the NASDAQ also kind of forming this kind of double top pattern here on the short term. coming out of that expiration. The Russell 2000 also forming a little bit of a double top in the short term, setting up some potential weakness with what would be a bearish high point as well, without the near term line getting up there above 80. Alright, again, a quick reminder before we look at some other charts here to subscribe to our YouTube channel. Click this red subscribe button that's right down below the video down here. There's also a logo here in the bottom right corner of the video. If you click the red mouse over it and then hit the red subscribe button, you can do that on any platform there. Also, click this thumbs up icon that's down below the video. That tells us, number one, you got something out of the video today, and number two, that you want us to do it again. All right, really quick and easy way to give us feedback. Again, thumbs up or thumbs down. I mean, either way, the more that you click on this, the more that also tells YouTube that this is an engaging comment. So actually, the worst thing you can do if you don't like the video is actually don't click on anything, because they look at any engagements and even comments down below as things. The more you see of that, the more that they want to promote it. So scroll down and add a comment on anything that you got out of the video, so that way when people come to watch it, they can see what you're getting out of it. Also here, while you're watching it on our blog, remember that we have our calendar over here on the right. There's also these links down here at the bottom for Twitter and Facebook, tonight's Market Outlook tweet and Facebook post. Click that heart right underneath the tweet. Again, that same thing lets Twitter know that you liked it, that it's engaging, that you want Twitter to keep promoting my stuff to you among all the different things that you may follow. Same thing with Facebook. When you click on this image, it takes you to your Facebook account. Just click that like button, and then of course you can always share it if you think anybody would want to watch it. Remember, you can also participate in our forums right above the video. You have to subscribe to our site, so if you click on this little image up here on the Join Market Scholars, it will take you to this page. You can see a really easy way to subscribe for free, and then you can participate in our forums with other market scholars who watch these videos day after day. Ask questions, comments, be able to go back and forth with anybody there. Alright, so back to the charts. You can see from a long-term perspective, we are pulling back down towards the 50. Remember, this gap here is kind of easy to fill when you have that gap. But still, I still wouldn't necessarily say that this is our test of the 200. Right, where we really need that kind of significant test of the 200 where we come up to it. Are we gonna hit it and hold? Here we kind of did hit it, and it held, and we came back down, only to do a similar kind of a double bottom-ish type pattern where we did come back up to it, and this time broke through, retested, and bounced. Then you have your bullish pattern there. So we'll look for that golden cross if and when we do get back to the 200-day moving average, and see again if it will hold or not. Of course, usually we get a test of the 50 first, and our test of the 50 includes a little bit more above it because of that little pre-Christmas Eve December expiration rally that we had that got us through that. Again, everybody was seeing the same thing, and a lot of times when everybody sees the same resistance or same support, you do tend to get fake outs in those areas, and that's very well what could have happened at that December expiration. Of course, headlines, any headline that can come out can throw any technical analysis, no matter how many people are expecting the same thing. And that could very well play a factor as well. We got a lot of potential for headline risk this week, that's for sure. Let's take a look at the 3 green arrow chart. And you can see we do have 3 green arrows. The momentum is falling like a rock, right? So we still have positive momentum according to the MACD, but it's close to nothing now. It makes sense. We had a nice little rally, and now we're flattening out. Stochastics, buyers are still well in control. According to stochastics, they're still trading over the last 5 days on average in the 83rd percentile of the 14-day range. So bulls are still in control. We're still closing a lot closer to the highs than we are the lows, is what stochastics is telling us. But it's coming back a little bit, and you can see we're flirting with that 8-day moving average on the MACD. And we're still closing above it, but we've had a couple days in the last week where we've traded a little bit below it. So, again, testing and breaking through that 17-day will probably bring us back down towards the 30 on any expected short-term weakness. So Stochastics is already below its moving average, and as you saw with the histogram, the MACD is close to crossing below its moving average as well. Volume picked up today, especially here at the open. You can see how these peaks and the averages rose up. So big volume at the open with the gap down. You notice still inside of last week's range. The purple line, remember, is this week's open on the Hakinyashi candle. And that's the other thing too that we didn't mention on the weekly chart. The Hakinyashi, when we typically get a reversal from strong bearish to bullish, we tend to get multiple weeks of smaller bodies and upper and lower shadows. We didn't get that. We only had 1 week, and then we had this sharp bounce, which is atypical. So this week looks likely for us to get that small body, and more than likely, if we get more of a pullback, the long. See, this is the open, the purple line. So we're already above it. We're getting a long upper shadow, which we're getting an upper shadow. It's not necessarily long, but any drop below this last week's low point would be a lower shadow, because that open's not going to change throughout the week. And we can drop all the way down to 255 and still easily trade in the upper half of the range. You notice that 4-week range is moving. So now it's only 23 points. That's less than 10%. It's the first time we've been below 10% of the 4-week range of the high in a long time, very, very long time. So it's starting to contract a little bit, and the rest of the week will probably stay here, but you notice it will move up even more. So until we start to really push through these highs, we've got the chance for some really narrowing of this is a word I'm trying to look for. Narrowing of the. In fact, this will probably end up being the low point of the 4-week range eventually, unless we push through the new highs. That's only going to be about an 11-point move, which is going to be less than 5%. Now we're really getting small on that 4-week range. So it kind of gives you an idea of how quickly things can change from very extremely wide to now pretty darn narrow. And again, a breakout below a narrow range would widen us out again during any kind of retest, right? Retest of that Christmas Eve low point. Again, doubtful we'll get to lower lows, but not doubtful that we don't get some weakness here during this particular expiration period from a seasonality standpoint I showed you on Friday, as well as the typical couple-month time frame that we get from initial surge low on Christmas Eve to a new retest low, whether it's a lower low or in this case probably a higher low because of how deep the surge low was. But it wouldn't be surprising for us to get that around maybe a little bit after February expiration, which would be a couple of months going from Christmas Eve. There was a slight gap, about a couple points, so that adds up to about 4-point range, still below the average. The volume at 85 million also still below average, which is getting a lot lower. So when you put this in context, 4 points, and the actual range for the trading session was 2, so that's really starting to bring the ATR down, and also it's below 1% here. And then volume at 85 million also bringing the averages down. So, again, another sign that, any kind of weakness we have is not going to be new bear market weakness because of how far these averages are falling. So when you go back to 2008 when we had that failed retest of the 200-day moving average here in May, and then that's when really the bear market kicked in, was right here. You had the death cross, the fail, the double, the retest of the low after hitting the 50, then the retest up towards the 200. Either here we get the golden cross and we take off, or we fail and we get a bear market, and that's what happened. Even then, you can see the ATR didn't drop. It stayed above 1.25 points. It never did drop below that 1% mark, which is where that bullish trend gets established. You can see the volume dropped to relatively low levels, down to about 170 million. In fact, here let's go to about right in this area. Let's go to June the 8th. There we go. So here's that June the 6th of 08. So we had that failed move right here, and you can see the volume was relatively low, and it didn't drop down to its lowest part of the 52-week range. There's that 1% mark again that we didn't fall back down to after all this week. Really, when you had that surge up to 2.5% on the ATR, We dropped, but we didn't drop that far down the 1%. We didn't drop enough. And you can see the volume also was there about on average 2 million, well off of its peaks, but also not necessarily at its lows either. Had pulled back. So now let's go back to what we're seeing now, and you can see the volume is at 4 million now instead of 2 million then. There's your 2 million mark right there. Excuse me, the ATR, sorry, is at 2, and you can see the volume here, and then the ATR is at 1.5%. So again, watch for that retest to see what it does, and then of course getting below 1% is when we, if we can get that breakdown coinciding with a golden cross again on the long-term moving averages, that's going to tell us that we are back to being bullish for the rest of the year and going forward. Finally, let's take a look at the volatility index. You can see we did jump back up to 20 today, so a big little jump up here. The last peak got us above 20. This is the current peak. So far it's not really a too bearish of a sign, but we did jump back higher. We are still in bearish territory up above this 95% mark. We came down again just below 95 and bounced. So as long as we stay in this kind of upper range towards 20 and this upper part of this ratio chart here on volatility, and then we're still expecting weakness until we break below 90%, most likely break towards 15 if not through it. That's when your bullish trend, intermediate trend, long-term trend will be established, and you'll get those multiple intermediate runs that we may very well could be on the first one right now, but I don't think so. I think any weakness we get over the next, through the rest of February expiration, if not through it a few days, will probably bring the intermediate line back down towards 50, if not below it a little bit. Then we get the bounce back up, back above the moving average. That will be more of a move like this that would establish us on that long-term run that we're just not getting yet here. Okay, so before we take a look at what's driving the price action today and our trade idea of the day, let's quickly summarize our technical outlook. We have a good bullish posture. It's mainly pretty strong because of how deep the correction was. We've had a nice, good, strong bounce off of so many different clusters that got us probably through some areas that a lot of people were expecting us not to get, at least on this current run. Whether or not that's legit, we'll find out in the next few days if that ends up being a fake out or not. But the expectation is we'll probably get more of a little bit more of an extended near-term weakness. How the shape of that weakness takes place, how deep it is, but there's we don't know. But the idea is things will probably be pretty volatile, and we'll probably get a little bit of a ramp up in volatility over the next few weeks through February expiration, if not a little bit beyond that. So that's the expectation. Of course, anything can happen, but that's what we're looking at based on our routine of looking at these different charts. So what do you think about that? Do you agree with that or disagree? There's a poll popping out right there. Click that link, opens up a poll, then hit either agree or disagree. If you click a disagree, scroll to the bottom, comment on what you're seeing that would suggest otherwise. Maybe you're seeing this as more than just a near-term correction, and it's going to be the beginnings of that bear market, or maybe you're seeing that we're a lot more bullish, that any pullback we're getting may be limited to what we've already seen. So let me know if there's any other indicators or patterns that you're seeing, and you can share that with other market scholars as well. And remember, you can follow me on Twitter for more content like this in between videos. Follow me with that account up there. And then also you can join our Market Outlook community we created on Facebook. There's a link there. And then you can join our daily Market Outlook email list that has a timestamped summary of what we talk about in these videos, as well as a list of all the overbought and oversold clusters in the S&P 500. So make sure you subscribe to our email list with that link popping out in the top right corner of your screen to be able to get those lists in that timestamp summary. All right, now let's take a look at the price action for today. And again, it was a Monday. On a busy week, Mondays typically are light. Of course, you had Caterpillar and NVIDIA kind of really driving. We'll talk about that when we get to the sector rotation. But driving investor sentiment today. But in terms of like how the market started the week, it started the week with crude oil and emerging markets really having some outperforming gains over the last couple of weeks, pulling back a little bit. Everything else really flattening out. You can see, again, over the last couple of weeks, everything is down or is up either 2% or less, or down 0.5% or less. So very, very tight range for a lot of these different asset classes. You did have a little bit of a late day rally in these equities. Let's just take a look just at today and what happened here. And you can see that we started off pretty bearish. Crude oil was down at one point, down 4%. The ETF for crude oil is down 4%. It rallied back up and finished less than 3%, about 2 2/3% down. You can see that also had an impact on other risk asset classes. All these equities asset classes were all down 1%, 1.5% or less. They finished today stronger. Small caps were only down 0.5%, and small caps ended up outperforming large caps. Dollar was everything else was really pretty darn flat. A little bit of an outperformance in gold today, but nothing really too significant to make a big difference in here. In fact, if you take a look at the chart for gold, if we take a look at the market forecast chart here for gold, you can see we had the big breakout move actually above 1300 a couple days ago, a couple sessions ago, and now we're up to 1312. So in fact we even got an overbought cluster on gold. You take a look at crude oil, and it had that big decline today. You can see that big decline, basically similar pattern of what you're seeing in equities. Very highly correlated right now to equities. You got the bearish near-term high point setting up with the near-term line coming down, even though we have a bullish posture. Its market sentiment's not above 20 yet, but you get the idea. The same idea here where we've had this big steep sell-off, and now we're basically kind of hitting some resistance. In fact, if I were to remove that drawing and draw the Fibonacci retracements in the other direction, from the high down to the low, then you can see we're pretty much approaching that 38% Fibonacci retracement level and holding it as of right now. Of course, the bigger issue what right now is what the dollar's doing. You can see the weakness in the dollar after hitting that 30-day moving average as a resistance, pulling back down. Still got the bearish posture, dark pink shading. Let's look at the 50 200-day moving average for the dollar, and you can see we're filling in the gap between the 50 and the 200. We haven't broken below the 200, but if we do, of course that would be very bearish for the dollar. That's not necessarily bearish for stocks, and in fact could very well be pretty darn bullish for stocks, especially for international stocks. And you can see from an international standpoint everything being down today, but not everything down as much. You can see there's the S&P, China, Japan also down, but look at Germany and France. They actually performed pretty darn well today. There's the UK down, similar to what you're seeing. India having a big decline in Brazil, so they've been kind of your better performing emerging markets. They dropped the most today. Everything else kind of very similar patterns. Italy also. So Germany, outside of the UK, France, developed markets did pretty well, especially in Europe. Everything else kind of matching the weakness that we saw in U.S. stocks, aside from your big winners lately in the emerging market space. Not necessarily big players in that space, but your bigger, more recent winners. Of course, the calendar gets busy. Tomorrow the FOMC starts, but you have consumer confidence, you have international trade, the house index, the Case-Shiller or house price index. So we'll get a look at housing prices. And then, of course, Wednesday, the big GDP number for fourth quarter, the advanced number, the Fed's press conference. That probably going to be pretty quiet until we head in, depending upon what the GDP is, until we get to that conference. And then, of course, by the end of the week, you have Chicago PMI, National ISM, construction spending, and the big one, the employment situation. And this week's earnings data is the biggest week in the S&P 500. A lot of big names due out, so be ready for some big numbers. You can see the economic indicators as a whole are pretty relatively flat for the U.S., which is a good thing compared to how negative they've been globally, which is why, again, we've had so much weakness globally relative to the U.S. And if the dollar does start to fall, you'll start to see those prospects reverse, where we'll do really well globally and not necessarily go down, but not do as well with U.S. stocks. Excuse me. Of course, tomorrow, all eyes will be on these rate hike odds, which are currently set at 2% for the rest of this year. They're not issuing new projections, but his comments will be dissected in that press conference to see whether or not we should continue to price in at least one rate hike, or if we should start pricing in the potential of a rate cut, or neither. So this chart will be definitely impacted by tomorrow's press conference, as it was pretty significantly impacted, if I were to go back to the historical chart here, by the December. Here's your December Fed meeting, and you can see the odds of getting no rate hike by December, mind you, took off at that meeting, and the odds of getting just one dropped to nothing immediately after that meeting, and then the odds of getting two, which were close to 20%, also dropped down to nothing immediately after that FOMC meeting. From a sector rotation standpoint, you can see the financial sectors and real estate has been really good performers over the past couple of weeks. Technology was until today, had a little bit of a decline today. In fact, if we just look at today's move and what happened here, you can see that technology, energy, which is not surprising, industrials, communication services, healthcare, and discretionary. So you're kind of your three bullish areas, your cyclical sectors, all really dropping pretty sharply. Real estate was up pretty decently well, over 1% by the end of the week, and staples also up. So you can kind of see these safe haven dividend type stocks doing pretty darn well. And you can see there's your staples there, whereas technology on the other end of the spectrum, off of its lows, but still pretty big losses for it during this pullback. And you would expect, if I were to come back here now and customize this time frame back to that December 24th low right there, up till now. So there's that low. There's your December 24th low, which continued into the 26th. In fact, here let's just do that. Let's do the custom time frame for the 26th. There we go. Then you can see. Oh, it's not gonna let me do it because the 24th wasn't a full day. So let's just go back to the 24th. So we had a little bit more of a decline down to 2%, but from that low point, you can see discretionary, technology, financials, industrials, energy, communication services have all been big winners. So if we do get any near-term weakness, it's going to come in those areas. All right, utilities and staples have been laggards. Expect some outperformance in those. You're already getting it in real estate. Expect some outperformance in these other areas as well during any kind of bout of short-term weakness. One stock that really had a good day today, relatively speaking, is American Airlines Group. You can see coming out of its earnings announcement, it broke above its upper Bollinger Band, broken out of this little volume node. Of course, you still got a little bit of resistance up here at 37, so it's not out of the woods yet. But you can see it broke. The bandwidth has room for it to expand. You look at the DMI oscillators, and here, let's pull up all the DMI indicators here. Here we go. You can see, AAL, that its positive line is crossing up above 25 and the negative line at the same time. And both these other oscillators, indicators down here at the bottom, are positive as well. So very kind of a positive breakout sign. If you look at the 3 green arrow chart for AAL, you can see you got 3 green arrows, 1, 2, 3, with 1.5 times the average volume, again coming before and after earnings. So a little bit of a breakout signal on that as well. Market forecast is showing you a move up above a rising moving average, so turning green at the same time that you're getting the intermediate line turning up above 50. So bullish trend opportunity here. If you look at the long term, charts for AAL. You can see it's been on the decline. You've had a little bit of a base forming, a little bit of a bullish divergence, so you have an opportunity for us to, we'll see if it comes up and hits that moving average like it did the last couple of times, the 200-day moving average, or if this is the time that we start a little bit more of a rally going forward from here and getting back up into these upper around this 45, 50, 55 area they were at the beginning of last year, setting up for a good opportunity for a trend trade on this. Again, where would you put stop orders? Well, again, you can put stop on trend trades. You put your stop orders below the low point that preceded the 3 green arrow signal. The low point, which is not very far away, the low point that we just barely had a few days ago here. You can set your stop order an ATR or 2 below that. And then start in small position, because remember you got some resistance here, so you don't want to do a full position until you break through that resistance. But we can start small now, see if it will break through, and then on any return move be able to add and get up to a full position, and then really ride any new trend that you are expecting from these signals, any new trend up towards closer up towards 52-week highs. Alright, well that wraps us up for today. As always, now I want to hear from you, so click that link popping out in the top right corner of your screen there. That will take you to our forums. Remember, you have to subscribe to participate there. You can do it for free, but comment in our forums. Any questions or comments you have for me, you can be able to engage with other market scholars there as well. If you can also answer questions there too, if you know them. It's a great place for the keep the discussion going that we have in the video with other people who watch these videos. So make sure you go there. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment down below. Also remember to follow me on Twitter for more content in between videos, and join our Market Outlook community that we created on Facebook. Thank you very much for watching. Have a great rest of your evening, everybody, and we'll see you all next time.